roads, our power grids, our food production, really our entire economy. If we ran out of oil tomorrow morning, our civilization would end tomorrow night. Obviously, that won't happen. But what will happen is that as oil production begins to drop from today's peak, our lives are going to get a lot more expensive. So expensive that we'll either have to change our way of life or we'll have change forced upon us. Make no mistake, the end of peak oil means that an energy crisis is coming, as I warned about in my book, The Ultimate Suburban Survival Guide. The question is, are you prepared?
So, Sean, you say we have to prepare for another energy crisis. How exactly do we do that?
Well, we have to develop alternative sources of energy.
Well, that's easier said than done, right?
Yes, but as hard as it may be, it has to happen. Over the next 20 years, we're going to see a huge increase in energy demand in places like India and China. Listen to this. If per capita oil use in India and China hit the same levels in the United States, the world's remaining proven oil reserves would be fully depleted in just 15 years.
And of course, we're not just talking oil here, right? We also consume a huge amount of electricity.
Exactly. The International Energy Agency has crunched those numbers too. They say from 1980 to 2006, the world's total electric capacity grew by 2.8%. And during the same period, total electricity consumption grew by 3.1%. So, production is falling behind demand growth. In order to keep pace with demand, investment in electric generation, transmission, distribution would have to hit $11 trillion by 2030.
And of course, our electricity is mainly generated by coal and natural gas. So how does that have an impact?
Yeah, 80% of it, and then nuclear reactors provide 9% of other commercial power, and then hydropower comes in at around 6%. For now, all the alternative energy sources, solar, wind, geothermal, biomass, they account for just 5% of electric power. That number has to come way up, if we want to keep pace with demand.
So out of all those alternative energy sources, where will most of the growth actually come from?
Well, wind and solar are the two technologies that are growing the fastest. But none of these sources by itself is actually going to be enough to satisfy our energy needs. Also, solar energy may work the best if you're living in the Southwest, but if you live in Central Texas, you might like wind power instead. So really, the only solution we have is to develop all of them at once.
Okay, lots going on in the alternative energy sector. Where should investors actually be focusing their time?
Well, in order to play this market, you have to have a strong summit. There are a lot of good alternative energy stocks, but they can experience some jaw-dropping ups and downs. If you're not comfortable with that, there are some funds that would insulate you from the worst of the drops, although they would probably still go down in a stock market correction, though I believe that they would perform longer term and outperform quite a bit. If you're willing to take the risk, I have some recommendations. You can find those in my report, The Golden Age of Green Energy, on uncommonwisdomdaily.com.
Okay, when we come back, Sean will give us his best and worst investments in the energy markets, and a bit later, find out why not everyone agrees on the direction of oil prices in the short term. All that when Money in Markets returns.
Hello, Sean Brodrick here. You know, Americans have a growing sense of anxiety and even dread, and no wonder. We are at increasing risk of disasters including fire, flood, an energy crisis, a food crisis, civil unrest, pandemics, terrorism, and more. You can sit on your couch and wait for things to happen, or you can start planning, start preparing, and be proactive. There are a lot of small things you can do that will help you enormously if the manure hits the fan. And that's what my book is all about. So please, as soon as you can, buy my new book. You never know when you may need it.
Get a free copy of the Ultimate Suburban Survivalist Guide when you subscribe to Sean's monthly bulletin service, Crisis Profit Hunter.
I'm back with Sean Brodrick. We're talking picks and pans. The natural resources market's a pretty scary place to be right now. So where should you be putting your money and what should you be avoiding? Well, Sean, let's get the pans out of the way first. I imagine you're looking at selling any stocks with exposure to this oil spill, right?
Exactly, BP first and foremost. In my Crisis Profit Hunter portfolio, we actually had BP, but I recommended that investors get out of BP as soon as the spill happened on April 20th. We took a small loss when we sold the shares, but obviously the damage could have been much worse the longer that I held onto them. Since the spill, BP stock has lost half its value. Now, normally a drop like that could represent a good time to buy, but this is not a normal situation. BP could go much lower depending on how long it takes to get that spill capped. In fact, I think it's possible that this could cease to be a public company. And if that happens, shareholders stand to lose everything.
And I imagine the other sell that you're looking at would be Transocean?
Right. Transocean is a company that operated the BP Deepwater rig. Its shares have also lost about half their value since April 20th. And a third company that I might stay away from is Anadarko Petroleum, symbol APC. It owns 25% of the Deepwater Horizon well, making it legally liable for what went wrong on the rig. Now that stock was also downgraded by Fitch. In general, I think that many companies that are heavily involved in offshore drilling could suffer, simply because deepwater oil exploration is so difficult and so fraught with the possibility of something like this happening again.
Okay, so where in the natural resources sector should investors actually be putting their money?
Well, there are some great energy stocks out there. One that I really like is ConocoPhillips. It's another extremely large integrated oil and gas company, but it's more exposed to natural gas and less exposed to deepwater drilling than BP and its other competitors. Because of that, COP shares, that's a symbol for ConocoPhillips, have held on to most of their value over the past couple months. Investors also like that the company has been raising its dividend and said that it will increase its share buyback program if market conditions continue to improve.
What about some smaller cap names?
Well, one of my favorites is Goodrich Petroleum, symbol GDP. It focuses on land-based drilling, mostly in East Texas and Northwest Louisiana. It has proven reserves of nearly 1 million barrels of oil and 415 billion cubic feet of natural gas. Now, investors have snapped up more than $1 million worth of GDP shares in just the past month, but it's still relatively inexpensive at about $14 a share. Finally, I would recommend Plains Exploration and Production, ticker symbol PXP. Plains does have some offshore interests, including a new offshore project off of Vietnam, but the bulk of its reserves are in California, the Gulf Coast, the Mid-Continent regions, and the Rocky Mountains. It's been beaten down recently along with the rest of the energy sector, but that just means you can pick it up on the cheap. Recently, the stock was trading near the bottom of its 52-week range.
Sean, thanks so much for joining us on Money and Markets.
Thanks for having me.
All right, when we come back, we'll get more investment picks in natural resources and the rest of the commodities sector. Find out why the short-term trends may be even more volatile than expected and what those price movements could mean for the other markets. Stay with us.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates, and that's what my colleague Nilis Mativ covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer, and I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
You've heard about the Gulf oil spill and what it means for the economy and natural resources. But what about the other markets? Once again, here's Jamie Holmes.
Welcome back. The oil spill in the Gulf of Mexico is the largest natural disaster in U.S. history, and it has put the commodities markets into a state of uncertainty. Stopping the spill and cleaning it up are top priorities, but the disaster also raises questions about the future of natural resources. How can you protect the money you already have in those markets and anticipate policy changes that may come as a result of the spill? Well, one way may be with exchange-traded funds, or ETFs. Joining us from his office in Austin, Texas, is a top ETF expert, Ron Rowland. Ron, how can investors guard against uncertainty in this energy market?
Hi, Jamie. Investing in commodity futures directly is risky because traders often use extreme leverage with their bets. But there's ETFs that allow you to invest in natural resources without the leverage. One of those is the United States 12-month oil fund, ticker symbol USL. It lets you buy and sell crude oil just as if it were a stock. It invests in futures contracts, but it's fully collateralized and there's no need to open a futures account. Of course, there are ETFs that let you play the oil market more aggressively. If you think energy prices will rise, some funds provide leveraged exposure to the crude oil. There's also inverse funds that allow you to make money when prices decline.
Okay, Ron, but it's my understanding that most ETFs dealing with the energy sector are essentially bundles of stocks.
That's right. And most of the time, ETFs that invest in energy stocks and those that invest in the underlying commodity move in tandem. But that's not always the case, which the oil spill demonstrates. I think the